Today on Think Smart with TMFG, Mike and I are going to be discussing premiums in investments. Mike, I like to think as premiums for those that think we're already getting too complicated at the start of our podcast is extra returns that are available versus traditional market returns.
We often go to educational conferences, and when we go, they always give us some stuff we know, and then they add some knowledge that we didn't have before. And we've talked many times about premiums and how they work, and we're going to reiterate a bit about what the premiums are and talk about that, and talk about some new things we learned about premiums and how they work together, which I think is a really important part that we're continuing to get a better understanding of.
So we're going to start with the first premium, and it's probably the easiest premium, I think, to understand.
Yeah.
It's called the equity premium. And I'm going to give you the definition. So the equity premium refers to the excess return that investing in the stock market provides over a risk-free rate, typically represented by government bonds or treasury bills.
So if you go and invest into the markets, you're going to expect an extra rate of return. Why is that?
Because you're taking more risk.
Yeah. Because otherwise, if you buy a treasury bill, you don't have to think about anything. You can put all your money in a treasury bill, and whatever they're paying that time, whether it be 1% or 3%, you don't have to think about anything. You're just guaranteed that rate of return. It's interesting when you talk to the more advanced people, they don't compare things to zero, because Why would anyone get zero, right? There's always a return out there. So if you buy treasury bills, you're going to get a certain rate of return without any risk. So let's see what we're going to get above those treasury bills by taking on that risk.
So what is the equity premium? If we were to quantify it, how big is it, Mike?
It can range, but usually it's about 6%. So if you look at, and it ranges, like we look at the S&P 500, it's been very good. If we look at the U.S. markets, that's been probably 8% or 7% equity premium. But when you look at the world markets, it probably settles down to somewhere around the 6 mark. And what that is that's, let's say, an 8% return, and we consider that you can get 2% risk-free. So that's where you come up with a 6% differential between those two.
Does the market give you that extra return every year?
Wouldn't it be great?
It's just straight line. You put your money in stocks and you get 8%, and if you stayed in cash, you got 2%.
Unfortunately, that 8% is very bumpy along the way.
And a lot of people understand that volatility or that bumpiness is risk.
Yep.
Okay, so that's the equity premium, and it's one of the most important premiums. So if you decide to allocate 50% of your portfolio to that equity premium, and it's giving you 8%, 50% of 8 is 4, and the other 50% is earning 2, so that gives you 1. So you've got now a 5% return versus a 2% return.
There used to be all these studies that were done when we started our career, and it talked about allocation, and they said asset allocation it would range between 88 and 93% of your return is based on asset allocation. And what I've realized over the years, 80 to 90% of that is based on the equity premium. Like we used to always think it was all the different markets, but in reality, what it came up to is how much equities as compared to how much bonds you have in the portfolio. Explained much of that asset allocation.
Right. Simply, those clients with more equities in their portfolio will earn a better return over time. And that time isn't necessarily 1 year or 3 years or even 5 years. But if you're there 10 years, 15 years, 20 years, you will have extra return.
It's funny. Every Monday, before we go into meetings for the week, what I have to do is we go through our meetings prep. We call it meeting prep. And we go through all the statements. And it's interesting because I know what everyone's return is going to be, right? Because ahead of time, I know what their allocation is. And sometimes something won't line up, right? Something doesn't make sense. And then you have to go and dig in the statement and find out what happened. Sometimes they would have bought a weird stock or did something weird in the account that would have caused it. But sort of by their allocation, by their equity premium, what their return should be.
Right.
And if they're not, you have to find out the reason why they're not there.
So next up, we're going to talk about the size premium. So I'm going to go through the definition. The size premium refers to the additional return that investors expect to earn from investing in small cap companies or smaller companies with a smaller market capitalization compared to large cap companies. So, Mike, why does that work?
It's about the risk. I always try to do a comparison with someone. If I told you if you want to buy Walmart, and Walmart's a pretty stable company, it's a very large company, what type of return would you want before I'd entice you to buy in Walmart? You'd probably say, if you said you can get 8%, you'd probably be pretty happy with Walmart, right? If I said I'm going to buy a convenience store down the corner, would you take that risk for 8%?
No, I would want 15 to 20%.
Yeah, before you go, because Walmart's going to be there next week. You don't know if that little corner store is going to be there, so you'd be silly to take that risk without getting a reward of 15 to 20%. And that's how the markets work. It's not all the time, but that's how they work. They price in that risk capital.
So here is some definition behind that. The rationale behind the size premium: smaller companies may have more growth potential, but they also face bigger business risks, less liquidity, and may not be as well established as those big companies like Walmart.
And remember, every big company was a small company.
Is this premium guaranteed? If I just put all my money in small companies, is that going to work every year?
It's a rocky ride, and it doesn't work all the time.
In fact, you can go through periods, 5-6 year periods, where it doesn't work.
Yep.
So it works over time. And when we talk about time, Mike, how many years do you need to be in something to capture some of that premium? Not all of it, maybe, but some of it.
I think it's really a 10 to 20 year time frame. I know that's long for anyone to accept, but to get any reasonable results, even 5 years isn't reasonable to look into judge premiums. You got to be a longer term time horizon.
So let me clarify that. Does that mean that if you went in for 5 years, you're not going to capture it?
There's a better percent chance you will, but
you might capture it in those first 5 years, but then the next 5 years you might not capture it. So you just don't know whether you're going to get it. But if you stay long enough, you're going to get it. It's like if you go to a hockey game, at the beginning of the game and stay to the end of the game, you're going to see every goal in that game unless you went out for a hot dog partway through the period.
Yep.
Okay. Next up is the value premium. Definition: value premium refers to the additional return that investors expect from investing in value stocks over growth stocks. In contrast, growth stocks tend to have higher valuations because they're expected to grow faster.
We always talk about this. The easiest way to explain this is if you go shopping at Fortino's or you go shopping at No Frills, right? You're going to go shopping and you're going to come up, and Fortino's is a great experience. I love it. They have the beautiful deli counters. You can get, it's a beautiful place. You don't have to put a quarter in your basket to go shopping.
They give you a free card?
Yeah, you get a free card. It's a nice experience. But at the end of the day, when you go and if you said, I'm going to spend $200, the cart of groceries you're going to leave with Fortino's is not going to compare to feeding your family than the cart you're going to get at going to a No Frills. And essentially what happens is that's the value premium. If you buy things that are, not as shiny, out of favor, that everyone doesn't like, it will probably give you a better long-term result over time. That's the simplest way to describe it, I think.
So does it always work?
Again, no. Sometimes you get rotten fruit. I mean,
right?
Yeah.
Sometimes you think it's fresh because it looked pretty good, but you get home and
Fortino's is pretty good. They have a good system. Whatever you buy there is probably going to be top quality. If you go into some of the other stores, maybe not. But overall, you're probably you'll have 5 other pieces of fruit will be okay to make up for it.
Well, I think one of the advantages to a place like No Frills is the turnover is tremendous, whereas the turnover in Fortino's isn't. In the middle aisles and the packaged goods, it really doesn't matter. But on those outside aisles where everything it's fresh meat and fresh veggies, you want fast turnover.
Yep.
So that's the value premium. As Mike said, it doesn't work all the time. It works most of the time. But again, you got to stay invested for at least 5 and 10 year periods before you're going to capture some of that return. If you're doing it for 20 years, you're going to capture most of that return. Next up is the profitability premium. This is I don't know whether it's a tricky one to explain.
This one's just right. It's intuitive.
It's an intuitive.
The other ones are against everything you think. This one is actually what you would think.
Why wasn't this the first factor that they discovered, the first premium that they discovered?
It's too obvious.
It's too obvious. So it's called the profitability premium. The profitability premium refers to the higher returns that investors expect from companies with strong profitability compared to those with weaker profitability. So what does that mean? Companies that make a high profit margin, like, on $1 million of sales, they're making $300,000 versus another company with $1 million of sales that's making $100,000. The one making $300,000 should do better as a stock.
Yep.
Pretty simple. Does it always work?
Again, no.
So here's what the definition says. More profitable companies tend to have higher returns on assets, have stable earnings. So their earnings are stable and exhibit better overall financial health, making them more attractive investments. All of those factors, so we've covered the equity, the small cap premium or size premium, the value premium, and now the profitability premium.
Now, are there other factors?
Absolutely.
There's literally thousands of factors, right? When you start to get into it. But we have to do research and find which factors, number one, are consistent, have some type of reliability to them. And you also have to see which factors you can capture, right? Capturing a factor is a whole different thing. There's certain factors out there that you can show exist, but the cost of trying to capture them is beyond what you'll get rewarded for. So it doesn't make sense to go after those types of factors.
So what we learned at this conference was how do these factors work together? And I think that was interesting.
Yeah.
Do these factors all work at the same time?
No.
So over a 10-year period, 53% of the time, one of those factors will have a negative premium. And even over a 10-year period, one of those four factors won't have worked. Maybe it's the equity premium, maybe it's the value, the small versus large.
We know because always someone's questions on one of the factors. They right now it's value. Value has been a bit of a pain, right? Because we've had these massive growth stocks. So everyone's going, well, value doesn't work. Value doesn't work. Well, yeah, for this 10-year period, maybe value didn't show its premium. Small cap worked, but the other ones seemed to work fine across the board. But last period of time, we've had a bit of struggle with value. But that doesn't mean next time we're going to see that show up. Maybe there'll be another factor. You know, profitability has been a very strong factor in the last 10 years, right? We've seen profitability as one of those leading factors. So you never know which one's going to lead you, but it gets more interesting when you start to go and add factors together. We said, 10 years, that's one factor doesn't perform. What about two factors?
It's down to 12%. So from 53 down to 12, where two of the four factors didn't work over a 10-year period. So
88% chance that you're going to be ahead of the game.
Right? So I always like to flip it around. The 12%, that means it could happen. Yeah, but the flip side of not using the factors is 88% of the time, two of them are going to work.
What about when you go to three factors?
0% of the time.
There's some weird market they went through and they had one, I think it's a Latin America emerging market or something like that came up where it was showing three that didn't work. But again, it was only a small percentage. I think it was like...
It's a small country.
Yeah, it was small countries and that got affected. So it can happen, but on the world markets, it's pretty safe bet.
Let's talk about the equity premium. And one of the terms Dimensional uses, and Dimensional, DFA, we talk about who managed the money for us. One of the things they talk about is it pervasive? Does it exist in all markets? Yeah. And the equity premium, the extra returns that stock gives you over the risk-free rate is pervasive.
Yeah.
So it works in Canada, it works in the US, it works internationally in Europe, Asia, emerging markets, you name it.
We know that one's there.
Do all the premiums work in Canada?
No. It's interesting. When we looked at Canada, I'm estimating here, but probably in 90% of the situations, most of the premiums work, but you'll find some outliers. And one outliner we saw was Canada on the small cap. When you look since 1975, Canada has not had a really large small cap, no premium for small cap. Then you have to figure out why did that happen? Well, maybe it's oil has become less out of favor or things like that, or some of the companies, mining companies in Canada were a big thing. They'd always be small cap. And I remember when we started our career, the mining companies were all scams, right? And you saw these small companies disappear. So you have, in a certain market, not all strategy is going to work. But in a globally diversified portfolio, yeah, the percentage is fantastic.
It works. So next up, and this has always been a question, I think, in all of our minds, in the back of our minds. These premiums are great, but surely you can time these premiums. Like,
we know
surely, if the stock market's been down for 3 years in a row, I should be loading up on the stock market. Or if value stocks have underperformed for 10 years, I better switch 100% to value.
Dying for a value premium right now, aren't we?
Right?
Yeah.
Like, we're waiting for it. So the question is, what does the research say about these premiums? And can they be timed? Can we switch from small to large at a certain point in time because it's underperformed or based on some indicator that's out there that it's about to perform? Value versus growth, profitable versus non-profitable. Can we do that?
So
what's the evidence, Mike? How did that work out?
What they did is they tried 720 different timing strategies. So they run everything through filters and say, okay, let's go test this and see what would have worked. And let's try all these different theories. And did they find some? Yeah, they were able to find some. And if they could time everything perfectly, like if they got everything right, let's say somehow in all these things they had won, we call these like Monte Carlo, the extreme condition. If you got everything right, you got about a 5.5% extra additional rate of return.
So if equities were, say, are going to give us 8%, even though we know in the U.S. it's been 10% over the last 100 years, the global markets haven't given you 10.
You knew it was going to be a growth year, you knew it was going to be a large cap, and you knew all this stuff, you got all that stuff right. You get extra 5.5%.
So I could go from 8% to, and if we use the U.S. market, I could go from 10% to 15.5%.
Yeah.
That's the best you could do with perfect timing.
But what they found is as you just change one of those factors around there, one of the parameters, you move one, all of a sudden you lose over half that return just by one of those parameters being off. Remember, we're trying to time all these different parameters. Just don't hit one perfectly, and all of a sudden half that's gone. And if you hit two perfectly, you're not getting there.
And that doesn't even include the costs of timing. So is there a cost to timing? You know, you can buy these ETFs for 8 basis points today.
Yeah.
And maybe you can trade it for free, but you're triggering taxes. Okay, maybe you're using a non-registered account. So if you filter it down and you did it just in your TFSA, even with perfect timing, you're only getting an extra 5.5% return. I think the biggest problem is most investors out there think that that's the missing ingredient. It's just timing.
At the end of the day, it's just not worth it.
Next up, are we actually passive in the strategies that we use with our clients? Is Dimensional Fund Advisors a passive money manager?
Well, let's even think of it. Our index is passive.
No,
because what are they trying to do? They're trying to create zero tracking error with an index.
Right.
And their phone, do they just sit and hold the same stocks that they did 40 years ago? Is the S&P 500 still have the same stocks it did in 1950? No. So obviously it's not passive, because if it was passive, there'd be nothing added to it. We just sit there, right? So this idea of passive gets a little bit, everyone's doing something to go to match up with something. The difference in what we do is index funds are trying to go and reduce tracking error. That's the goal in an index fund. What we're doing through the strategies we use is we're trying to take advantage of those known premiums that we just discussed. So we're not going to be passive. We're not going to sit there because we just spent 15 minutes talking about these premiums that we know exist. Why would we not take advantage of them? That would be sort of silly. It's like if you knew the results of a horse race and you didn't want to go and take advantage of it. We know these things work over time, so why not use them?
So, Mike, I'm sure most money managers in the world do research.
Yeah.
What's the difference between research and evidence?
Research is trying to find evidence behind your point of view. Evidence is taking what's out there and implement it into your strategy. It's a big difference.
So do we use research? Do we use evidence? What's the strategy?
We use evidence. We find out what the case is, if there's anything that's valuable out there to us, and then that gets implemented into the portfolio strategy. What many companies do is they find what's popular, and they go try to create evidence to support what is popular and sellable. It's the terrible part of our industry. We see cryptos and all this stuff. They're trying to come up with evidence to show you should invest in crypto. They try to spend evidence you should be in income funds or evidence to support this stuff. But they just know there's a piece of the market that they can take advantage of and sell things, and then they want to create a background of evidence around it. And it's not true evidence, it's data mining. And there's a big difference between data mining and evidence. And we are evidence-based investors. We find out what is there in evidence, and then from there, we use it to our advantage.
We're coming up on 20 years this November. I'm not sure when this podcast will go out, that we first came down to a dimensional conference and learned about evidence-based investing. I thought there was a comment at one of our presentations we went to where the head of the company talked about the comparison to science. And what he said is our portfolios will be better 5 years from now. And it's the same way our understanding of medicine will be 5 years better from now than it is today. We know that. It's always gotten better, our understanding of medicine and how it works and the implications. And so there will be some new evidence that we discover in the future.
And as it comes up, we'll continue to add it to our designs.
So today we discussed what the premiums are, how they work together. That brings us to the end of another week. This is Rob and Mike with Think Smart with TMFG from the McClelland Financial Group of Asante Capital Management.